A topic most discussed in stock market circles this year is India's underperformance relative to other markets. Why is India underperforming most other markets this year? While many markets have set new records, why is it that India's benchmark indices, Sensex and Nifty, are still hovering around the September 2024 highs? Is the market on the verge of a breakout? These are the questions that are dominating stock market discussions now. Let us try to find the answers to these questions. Welcome to Geojit Spotlight. It is true that India's underperformance this year is huge. This is the worst in the last 30 years. But this conclusion ignores an important point. If you take the last 5 years, that is the period from November 2020 to November 2025, or to be exact, 20th November 2020 to 20th November 2025, India is the best performing stock market. This is an important data which many investors do not know. Now, what are the returns during the last 5-year period? Let us look at the data. Hong Kong Hang Seng Index minus 4.14. Shanghai Composite, China, 14.14%. Euro Stocks 50, 60.63%. US S&P 500, 83.8%. Japanese Nikkei, 92.9%. Nifty, 103.69%. It is very clear that India is the clear outperformer if we take the last 5-year period. Therefore, 1 year of underperformance need not be a serious issue. More important, we should ask why this underperformance? What factors contributed to this underperformance? Are these factors which contributed to the underperformance getting reversed? Are there triggers for a catching up? Let us examine this. Let me repeat one point which I have explained many times in the past. In the long run, the market is a slave of earnings. In the short run, many technical factors will impact the market, but in the long run, the market trend will be dictated by corporate earnings. If earnings rise, market goes up. If earnings growth declines, the market corrects and then consolidates for a period. After the COVID crash of March 2020, the market rallied impressively. This rally had the fundamental support from earnings growth. During FY21 to FY24, Nifty earnings grew by an impressive 24% CAGR, 24% CAGR. Then in the next year, FY25, Nifty earnings growth declined to a poor 5%. This pushed up the valuations to high levels much higher than long-term averages. Market experience is that in the long run, the valuations will revert to the mean. That is, valuations will come down to the long-term average. This was what happened during the correction and consolidation stage of the last 1 year. Another factor that led to India's underperformance was the AI trade in artificial intelligence stocks, which dominated global markets this year. FIIs, particularly the hedge funds, sold heavily in India and moved the money for the AI trade. Now let me come to the positive news of reversal in these two factors. Number one, earnings growth in India is improving. Q2 results have been better, and there are indications that earnings will improve further from Q3 onwards. In FY27, Nifty earnings growth can be around 15%. The market will start discounting that. Secondly, the AI trade is slowly fading. AI stocks have corrected, whether in US or in Taiwan or in South Korea or even in Japan. If this trend continues, FIIs will stop selling in India and start buying non-AI stocks in markets like India. Recently, if you go by the data, FIIs have stopped big sell in India, and during the last few days they have started buying, even though the buying is in small quantities. If this trend continues, the market can rally. However, watch out for the US tech market. If there is a big crash there, all markets will be impacted. So watch out for the developments in the tech market, particularly in the US markets.